Indicators can feel overwhelming. Charts packed with lines, colors, and signals that only confuse you. In this video, we'll simplify everything and focus on the 10 indicators that truly matter. The unique edge each indicator gives you. How top traders put them to work across crypto, stocks, and forex. Practical tips for deciding which ones fit your personal trading style. How to avoid indicator overload and keep your charts clean. By the end, you'll know exactly which tools deserve a place on your screen and which ones you can finally ignore. Number 1. Moving averages, SMA and EMA, the backbone of trend analysis. They smooth price action and help spot the direction of momentum. EMAs respond faster to price changes, while SMAs give a cleaner long-term view. Moving averages are the foundation of technical analysis because they transform noisy price action into a clear picture of trend. A simple moving average, SMA, takes the average closing price over a set period, like 50 or 200 candles, and smooths the chart so you can quickly see whether the market is trending up or down. The exponential moving average, EMA, gives more weight to recent data, so it reacts faster and is ideal for shorter-term traders who want earlier signals. A rising 50 EMA, for example, can act as dynamic support in an uptrend, while a falling 200 SMA highlights a major bearish market. Many traders look for crossovers, such as the classic golden cross, when the 50 SMA crosses above the 200 SMA, to confirm a major shift in direction. Whether you swing trade stocks, scalp crypto, or trade forex, a pair of thoughtfully chosen moving averages can keep you on the right side of momentum and filter out random noise that might otherwise push you into emotional trades. Number 2. RSI, Relative Strength Index. This indicator measures momentum and spots overbought or oversold conditions, but its real power is in catching early reversal clues. The RSI is a momentum oscillator that tracks how quickly and strongly price has moved in recent candles, scoring that strength on a 0 to 100 scale. Readings above 70 often signal the market is overbought, while readings below 30 suggest oversold. The real edge comes from divergences. When price makes a new high, but RSI fails to make a higher high, buying momentum is fading, and a pullback may follow. A bullish divergence is the opposite. Price prints a lower low, while RSI forms a higher low, hinting at a potential rebound. Many traders also watch for midline crosses around the 50 level to confirm trend strength. Because RSI works across multiple timeframes, you can pair a higher timeframe RSI to spot the broader trend with a lower timeframe RSI for precise entries. Just remember, it's a warning system, not a standalone trade trigger. Number 3. Moving Average Convergence Divergence, MACD. MACD combines the best of moving averages and momentum analysis into a single tool. It plots two lines, the MACD line, which measures the difference between a fast and slow EMA, and the signal line, which is an EMA of that difference. When the MACD line crosses above the signal line, you have a potential bullish shift. When it crosses below, momentum is turning bearish. The histogram visually displays the distance between the two lines, making it easy to spot when momentum is accelerating or fading. Traders often look for MACD line crosses that occur above or below the zero line to confirm the strength of a trend. It's particularly powerful in trending environments, helping you ride moves while momentum stays strong. Combine MACD with support and resistance or higher timeframe structure to avoid whipsaws in choppy markets, and it becomes a reliable guide to both entries and exits. Number 4. Bollinger Bands. Bollinger Bands wrap a moving average in two dynamic volatility bands, typically set two standard deviations away. When price rides the upper band, bullish momentum is strong. When it hugs the lower band, bearish pressure is in control. The real magic is the squeeze. When the bands tighten, volatility is low and a breakout often follows. A strong candle closing outside a band can signal the start of a new expansion phase. A spike beyond a band that quickly reverses often marks an exhaustion move and a likely mean reversion back to the middle band. Bollinger Bands also shine in trade management. A trailing stop just outside the band can lock in profits while keeping you in the trend. They work on any time frame and pair well with momentum tools like RSI for extra conviction. Number 5. Fibonacci Retracement. Fibonacci retracement levels come from the famous sequence found in nature, art, and financial markets. Traders plot these levels from a swing high to a swing low, or vice versa, to spot potential support or resistance as price pulls back within a trend. The key ratios: 38.2%, 50%, and 61.8% are watched globally, creating a self-fulfilling effect as many traders set orders there. After a strong bullish run, a retracement into the 61.8% zone often attracts buyers looking for a high-reward entry before the next leg up. Confluence is everything. When a Fibonacci level lines up with a major moving average or prior horizontal support, the chance of a strong reaction rises. While not a traditional coded indicator, Fibonacci retracements remain a timeless roadmap for measuring healthy pullbacks and pinpointing zones where the crowd is likely waiting to step in. Number 6. Volume Weighted Average Price, VWAP. VWAP shows the average price of an asset for the day, weighted by trading volume. Big institutions watch it to gauge whether they're getting a fair deal. When price trades above VWAP, buyers are in control. Below, sellers dominate. Intraday traders treat VWAP as a dynamic support or resistance line, buying dips near VWAP in an uptrend or selling rallies to VWAP in a downtrend. It separates healthy breakouts from quick spikes. A breakout that holds above VWAP with strong volume carries more conviction. Because VWAP resets daily, it's a favorite for day traders in stocks and crypto futures. You can also anchor VWAP to a specific event, like an earnings release or economic announcement, to see the true average price from that moment and gain an institutional-grade view of value. Number 7. Stochastic Oscillator. The stochastic oscillator compares a market's closing price to its price range over a set period, typically 14 candles. It plots two lines, %K, the main line, and %D, a moving average of %K. Readings above 80 hint that the market is overbought, while readings below 20 signal oversold conditions. The strongest clues come from crossovers of %K and %D near those extremes. A bullish crossover near 20 can anticipate a bounce. A bearish crossover near 80 can warn of a pullback. Some traders confirm trend strength by watching the oscillator's direction relative to the midline. Because it reacts quickly to price changes, the stochastic oscillator is excellent for short-term trades. Just be sure to combine it with higher time frame structure so you don't get faked out by every small swing. Number 8. Average True Range, ATR. Average True Range is all about volatility. It measures the average distance between highs and lows over a chosen number of periods. ATR doesn't show direction, only how much price typically moves. That makes it powerful for risk management. You can size positions or set stop losses using a multiple of ATR, so your stops aren't too tight in volatile markets or too loose in quiet ones. For example, a stop placed 2 times the ATR away from entry automatically adapts to the market's current volatility. Traders also watch ATR for volatility shifts. A rising ATR often signals the market is moving from a quiet phase into a big move. Because ATR is neutral to trend, it works equally well in stocks, forex, or crypto. Mastering ATR means mastering the art of matching your risk to market conditions, something even many experienced traders overlook. Number 9. Volume profile/market profile. Unlike simple volume bars at the bottom of a chart, volume profile shows how much trading volume occurred at each price level across a selected range. It builds a horizontal histogram that highlights where the most business was done, the high volume nodes, and where little trading took place, the low volume nodes. High volume areas often act as strong support or resistance because they represent fair value zones where buyers and sellers agreed on price. Low volume zones can turn into fast-moving areas where price slices through with little friction. Traders watch key features like the point of control, the single price level with the most volume, to spot magnets and targets. Volume profile lets you see the market through the eyes of professionals and, when combined with classic technical tools, gives you an X-ray of the auction process behind every candle. Number 10. Ichimoku Cloud. The Ichimoku Kinko Hyo, most traders simply call it the Ichimoku Cloud, can look intimidating at first, but it's really a complete trading system in one indicator. It plots multiple moving averages and projects them forward to create a cloud that defines trend direction, support, and resistance all at once. When price is above the cloud and the cloud itself is rising, the market is in a strong uptrend. When price is below the cloud and it's falling, bears are in control. The Tenkan Sen, fast line, and Kijun Sen, slow line, provide quicker and slower trend signals, and their crossovers can trigger entries. The cloud's forward projection helps you anticipate future support and resistance zones. Once you understand the relationships between the lines and the cloud, Ichimoku gives you a remarkably complete view of market conditions, perfect for swing traders and even long-term investors. Thanks for spending a few minutes sharpening your edge. Like and subscribe for weekly breakdowns.